What if the greatest enemy of superior investment results isn't a flawed strategy, but a wallet that has simply grown too fat?
Well, it is a profoundly counterintuitive proposition.
Right.
I mean, we're entirely conditioned to believe that having immense capital just, solves all problems.
Right.
The assumption across traditional finance is that sheer financial mass acts as this absolute undeniable advantage. But when you begin to rigorously examine the underlying mechanics of scale, that assumption completely fractures.
Yeah, and that is exactly what we're dissecting today. We're doing a deep dive into an article from the Averaging Up collection titled Heavy Tolls and Light Tolls.
Yes.
And we are looking specifically at the author's analytical framework regarding how the world's most successful capital allocators view scale, advantage, and really just the fundamental architecture of a business.
Which is such a vital framework to grasp.
Absolutely. So if you are listening to this, you likely want to understand why enormous capital expenses, which are traditionally viewed as a massive drag on a balance sheet, why they can actually form an impenetrable moat.
Precisely. Because conventional wisdom dictates that any growth requiring immense capital expenditure is a severe disadvantage.
Right, a total liability.
Exactly. So our objective here is to fundamentally reevaluate that architecture through the lens of this article. The author builds a really compelling case that the best type of business does not exist in a vacuum.
No, it doesn't.
Rather, it depends entirely on the size of the investor's bank account.
Okay, but to understand this heavy architecture, we first have to define the light. The author's framework begins with a foundational equation for business architecture, which is simply A plus B.
And that simple equation serves as the bedrock for the entire analysis.
Break that down for us.
Sure. So the premise is that every single business, regardless of its industry or sector, contains two distinct opposing forces.
Okay.
The A represents the toll. This is the cash the business collects today simply by existing and taking a fraction of the world's ongoing economic activity.
Right, the toll you pay at the booth.
Yes. And the B represents the wave. This is the structural, unavoidable cost required to fund growth for tomorrow.
Okay, let's unpack this. Because what separates an ordinary grinding business from a truly extraordinary one is the cost of that B.
Absolutely.
When a business can achieve growth at zero marginal cost, meaning, it requires no new factories, no massive capital expenditures, and no brutal, margin-crushing fight for market share, the author categorizes that entity as a freesurfer.
A freesurfer.
Yeah, is what we call the light toll.
Right. And the defining characteristic of a light toll's architecture is that the cost of B is, for all intents and purposes, zero.
E0.
Growth is effectively free.
To visualize this, let us look at the prime example cited in the text. We're talking Visa, MasterCard, S&P Global, and MSCI.
Perfect examples.
I mean, Visa is a pristine example. It collects a fraction of a cent on billions of global transactions.
Right.
But crucially, to process 10,000 more transactions tomorrow than it did today, Visa does not need to lay an inch of asphalt, build a physical road, or, construct a new manufacturing facility.
No, the infrastructure is already there. And the same logic applies to MSCI. They effectively skim a fee from trillions of dollars in passive investment assets.
Trillions?
Trillions, yeah.
Right.
As global commerce expands or as broad asset prices rise, the revenue of these businesses scales upward automatically.
Without needing a massive reinvestment.
Exactly. They require almost no retained capital to fuel that growth. Consequently, traditional financial analysis has historically treated this as the absolute highest form of business architecture.
It is often described as the purest compounding machine ever assembled. I like to think of a light toll like earning a digital turnstile.
A digital turnstile, yeah.
The physical maintenance of that turnstile is virtually zero. But every single time the global economy takes a step forward, the turnstile spins and you collect a fee.
It is a brilliant model.
It really is. But applying logical deduction here brings us to a critical question.
Okay, what is it?
Well, if these light tolls are indeed the purest compounding machines, why wouldn't a rational, sophisticated investor exclusively hold them? I mean, why even bother looking anywhere else?
That exact question exposes the hidden limitation of the light toll. It is the pivot point of the author's argument, really paving the way for a central reversal.
Okay, walk us through that reversal.
To grasp that limitation, we have to look at the exact opposite side of the spectrum. We have to define the heavy toll.
And these are the businesses built from concrete and steel. We are talking about physical railways, national airports, electrical utilities, and major aircraft engine franchises like GE Aerospace.
Yes, the heavy industrials. For these entities, their inherent cost of growth is incredibly expensive.
Massive.
Massive. Growth for a railway cannot happen digitally or automatically. It must be paid for in physical infrastructure. To move 20% more freight across a continent, you must lay down thousands of miles of new track, acquire vast tracts of land, and purchase entire fleets of locomotives.
Or, to power a growing city, a utility must build immense new turbines and expand grid connections.
Exactly.
Historically, traditional market analysis looks at that immense capital requirement and flags it immediately as a structural weakness.
Oh, absolutely. It is seen as a perpetual drag on free cash flow because the business is constantly forced to reinvest its profits just to maintain its growth trajectory.
So it's heavily penalized by analysts.
Right. But what's fascinating here is the author's complete inversion of that exact logic.
How so?
The framework argues that for a light toll, the economic moat is what protects the free growth. It is usually a powerful network effect or deeply embedded regulatory standards that keep rivals at bay.
Like Visa's network.
Right. But for a heavy toll, the enormous cost of growth is the moat.
Ah, the cost itself is the barrier.
Precisely.
Let us explore the specific $80 billion railway hypothetical from the text because it perfectly clarifies this inversion.
It's a great example.
Imagine a fully functioning national railway. If a rival corporate entity decides they want a piece of that market, they would have to spend roughly $80 billion to build a second parallel railway right next to the existing one.
Right, which is just a staggering amount of capital.
Yeah.
And the economic rationale preventing that is ironclad.
Because if a competitor actually managed to raise and deploy that $80 billion to build a second track, what happens to the market?
The two companies would immediately split the existing freight traffic.
Yeah, because there isn't magically twice as much freight just because a second track exists.
Exactly.
So their revenue is halved, but their initial massive debt burden remains identical.
Right, because the initial capital outlay was so staggeringly high, dividing the revenue pool means neither company would earn its required cost of capital.
Did go bankrupt.
They would both face financial ruin. Therefore, the threat of mutual destruction prevents the competition from ever breaking ground.
So the sheer expense of the infrastructure guarantees the monopoly.
Yes. The massive capital requirement that initially looked like a severe weakness is the precise physical barrier that keeps the toll completely uncontested.
Wait, I have to push back here to ensure we are maintaining intellectual rigor.
Go ahead.
Capital intensity is notoriously dangerous. It historically destroys shareholder value across dozens of industries. I mean, how do we objectively differentiate between a business that is absorbing billions of dollars to build an impenetrable moat and a business that is simply burning cash in a massive capital trap?
That is a very fair point, and it's the essential challenge for any allocator.
Yeah.
But the article provides an absolute rule to navigate that distinction.
Okay, what is the rule?
The framework states that capital intensity is only a moat if it produces a consolidated oligopoly that consistently earns returns above its cost of capital.
Okay, let us break down those mechanics for absolute clarity. Because cost of capital is essentially the minimum return an investor demands for providing funds to a company relative to the risk.
Right.
If I can get a guaranteed 5% return simply by putting my money in a risk-free government treasury bond and doing absolutely nothing, I need a business to offer me significantly more than 5% to justify the risk of lending them my capital.
Exactly. You need a premium.
So if business spends $1 billion but only generates a 3% return, they are entirely destroying value. The heavy spend isn't a moat in that scenario. It is an incinerator.
That is a perfect distillation, an absolute incinerator. To see how this applies, let us contrast the railway with the commercial airline industry, as the author does.
And not a great comparison.
On the surface, they possess identical capital intensity. Both require billions of dollars in highly specialized physical assets.
Trains and tracks in one instance versus massive fleets of commercial aircraft in the other.
Right. Yet the historical outcomes for shareholders in those two industries are entirely opposite.
And the divergence is entirely due to the structure of the market they operate within, isn't it?
It is. The railway is deeply consolidated, physically irreplaceable, and heavily protected by the immense difficulty of replicating its land routes.
So nobody's building that second track.
Exactly. Therefore, it commands absolute pricing power and reliably earns returns greater than its cost of capital.
But the airlines...
The airline industry, conversely, is highly fragmented. Furthermore, its core product, a seat on a flight from one specific city to another, is largely interchangeable in the eyes of the consumer.
Yeah, I mean, if airline A and airline B are flying the exact same route at the exact same time, the consumer almost universally chooses the cheaper ticket.
Yes,
So the airlines are trapped in a fierce, perpetual competition on price.
precisely. And because they compete so ruthlessly on price just to fill seats, they persistently fail to earn returns above their cost of capital.
So the absolute rule of the heavy architecture holds: identical capital intensity. But the massive spend is only a moat when it absolutely cannot be competed away.
Right. It is a value-destroying trap whenever it can be competed away.
So if we have firmly established the heavy toll as a viable, highly defensible fortress when executed correctly, the analytical conversation must shift.
Where to?
We have to ask who actually needs to live inside that fortress.
Ah, yes. This brings us to the epigraph of the article, which utilizes a famous quote from Warren Buffett. A fat wallet is the enemy of superior investment results.
That quote perfectly encapsulates the reinvestment problem at massive scale.
It really does.
I mean, the more capital an entity must deploy, the fewer destinations exist in the global market that can actually absorb that capital while maintaining high returns.
Yes, and the author uses the paradox of MSCI to illustrate this mathematical reality. Earlier, we established MSCI as the purest Freesurfer, a structurally perfect light toll.
Right. Growth is practically free.
But let us look at the arithmetic of scale, using the article's example of Christopher Hohn, who manages a massive $77 billion institutional fund.
$77 billion. That is a staggering amount of capital to deploy.
It is. If Hohn rigorously analyzes the market and decides he wants to deploy $10 billion into a structurally perfect light toll, he physically cannot put it into MSCI without breaking the very mechanics of his investment.
Wait, why not?
Because MSCI's overall market capitalization simply cannot accommodate a sudden $10 billion influx from a single buyer efficiently.
Oh, I see.
Hohn would end up buying a massive controlling stake, driving the share price artificially sky high against himself in the process.
Right, ruining his own entry price.
Exactly. And he would still likely have billions of dollars in unallocated cash left over that desperately needs a home.
Here's where it gets really interesting. Think about the mechanics of this using an analogy.
Okay.
It is the exact equivalent of trying to empty a high-pressure fire hose into a delicate, perfectly crafted porcelain teacup.
Oh, that's a brilliant way to picture it.
Right. The rushing water represents the massive capital of the institutional fund, and the teacup represents the highly efficient, structurally perfect light toll. The teacup is flawless at what it does, but it simply cannot absorb the immense volume.
No, it can't.
The pressure of the water will shatter the cup or simply overflow instantly, leaving most of the water uncontained.
A giant wallet does not need a teacup. A giant wallet requires a massive reservoir.
That is the precise mechanism driving the behavior of the world's greatest capital allocators. This is why sheer scale invariably bends the institutional investor toward the heavy toll.
It's forced upon them.
Exactly. It is not because the heavy toll is a mathematically superior business in a vacuum. It is because the heavy toll possesses the vital physical capacity to absorb what the light toll simply cannot.
Let us move from the theoretical mechanics of the fire hose and the teacup to real-world deployment. How are these elite allocators actually behaving right now? The article provides two deeply compelling case studies.
Yes, the first is Berkshire Hathaway.
Okay, tell us about Berkshire. Well, Warren Buffett has publicly admitted for years that immense size is the primary enemy of performance at Berkshire Hathaway, and he has stated that he sees no easy way to solve that problem.
Because his wallet is the fattest of them all.
Precisely. And for an entire decade, Buffett notoriously missed investing in Google. During that period, Google operated as a pure capital-light search tool. It was the ultimate Freesurfer.
Right.
And he has openly called that omission a mistake.
But the author notes a fascinating fundamental shift in Berkshire's strategy.
Yes.
Berkshire Hathaway recently committed $10 billion to Alphabet, and they executed this massive commitment exactly as Alphabet formally announced a staggering $190 billion capital expenditure plan to build out the physical infrastructure for artificial intelligence.
The underlying logic there is just brilliant.
Why is that?
Alphabet is essentially building a heavy, intensely capital-demanding second toll right beside its original capital-light search tool.
Right, because developing advanced artificial intelligence is no longer merely about writing efficient code.
Far from it. It requires purchasing vast tracts of land, building colossal data centers, installing massive cooling systems, and securing dedicated power generation.
This is quite literally concrete and steel for the digital age.
It is.
So by deploying $190 billion into physical infrastructure, Alphabet is physically widening its moat against competitors who simply cannot afford that price tag.
Yes. And simultaneously, the giant wallet seeks a toll large enough to hold it. Buffett is drawn to Alphabet now, precisely because the sheer scale of the AI build-out means the company can finally absorb massive amounts of institutional capital at a highly dependable, heavily protected return.
It's the reservoir he needed.
Exactly. And we see identical structural logic in the second case study, which examines Chris Hohn.
The manager with the $77 billion fund.
Right. Hohn is deliberately designing a portfolio architecture that entirely respects this reality of scale. The article details how he recently reduced his prominent position in Microsoft from a massive 10% weighting down to a mere 1%.
Wow. He systematically sold roughly $8 billion of Microsoft stock.
Yes. The text suggests this was partially due to the perceived threats AI poses to establish highly profitable franchises like Azure and Office.
But far more importantly, he used those massive proceeds to aggressively fund Alphabet's heavy infrastructure build, making it his largest single technology holding.
Right. And what is critical to observe in Hohn's strategy is that he does not force himself into a binary choice between the two architectures.
Right. It's not one or the other.
No. He maintains substantial positions in classic light tolls, such as Visa, Moody's, and S&P Global. But he strategically holds them alongside immense, capital-devouring heavy tolls.
I mean, his single largest position overall is GE Aerospace. He holds prominent stakes in Canadian National Railways, the massive Spanish airport operator Ahina, the aerospace manufacturer Safran, and the global infrastructure group Ferrovial.
He is deliberately compounding his institutional capital behind massive walls that competitors cannot afford to scale. He understands the author's core thesis. Both architectures successfully collect a toll while the world performs its daily economic activity. The light toll compounds freely and efficiently, while the heavy toll deploys billions of dollars behind an insurmountable physical and capital wall.
So what does this all mean for you, the listener, who is carefully managing your own portfolio, rather than a $77 billion fund?
Well, if we connect this to the bigger picture, the deepest, most profound conclusion of the author's framework turns out not to be about the mechanics of the businesses themselves.
No.
No, it is fundamentally about the investor. There is no single best architecture that exists in a theoretical vacuum. There's only the best architecture for the specific size of the capital you currently carry.
So for the individual investor, the reality of the lean wallet applies.
Exactly, because you are not attempting to seamlessly deploy $10 billion in a single transaction without disrupting global markets. The Freesurfer, the pure light toll, remains absolutely supreme for your purposes.
You have the luxury of using the teacup.
Yes, you do. For a lean wallet, its growth is virtually free, its economic trajectory is highly visible, and importantly, the modest cash it returns to you as dividends or share buybacks is easily and efficiently redeployed elsewhere in your personal portfolio.
So your optimal posture as an individual investor is essentially to be paid to do nothing while the turnstile spins.
As the article bluntly states, there is no better place to be. The transition to the heavy toll is driven entirely by structural necessity. It is a reservoir designed for capital that simply has nowhere else to go.
Because a fat wallet cannot fit through a narrow toll.
Exactly.
The fundamental takeaway from the averaging up framework is that your specific scale dictates your optimal strategy. Which leaves us with a final, expansive question to ponder as we conclude this analysis.
Let's hear it.
If optimal architecture is strictly dictated by the size of your wallet, how does this framework apply beyond pure finance?
Oh, that's an interesting angle.
Right. Consider your own career progression, your daily allocation of time, or your accumulated intellectual capital. Early on in a career, you naturally seek highly efficient, low-friction teacups, acquiring quick skills, taking on agile projects, and moving rapidly.
You're a Freesurfer.
Exactly. But as your professional expertise, your network, and your resources grow incredibly large, do you eventually hit a scale where you must deliberately stop looking for easy, capital-light efficiency? Do you eventually need to start building heavy, time-intensive, structurally massive moats in your own professional life to protect your immense value from being easily replicated by others?
That is a profound question to leave on.
It really is. This content is educational and reflects a personal analytical framework. It does not constitute investment advice. Visit averagingup.com to explore the full collection.